Hey, what's up, everybody? It is Friday, yeah, May 27th. Started a long Memorial Day weekend. Oh, we got pretty crappy weather here in New York City. I hope it's going to be nice wherever you are. So, good week in the market. We closed up for the first time in 7 weeks. It was the biggest up week since November 2020. Folks, I mean, I told you this was going to happen. This goes back to, I said once the monthly federal budget balance flipped back into deficit, you know, that's going to be the market bottom. And that's exactly what happened. I mean, we saw the budget balance for May flip back into deficit on May 16th. And that was literally like the bottom of this sell-off. What I've been trying to explain to you guys is the difference between real liquidity, which is net government spending, government deficit spending, that supplies the dollars into the economy, as opposed to fake liquidity, which the psychotic monetarists, people who have this psychosis over monetarism and monetary policy, they always ascribe that to central bank monetary operations, and it's just not. I mean, you know what those things are? Those are asset swaps. Those are the recomposition of financial assets in the economy. Real liquidity, whether that's providing liquidity or draining it away, that comes from fiscal operations, and we saw a very sizable drain in liquidity on April 18th through early May, when the federal budget balance was in surplus, at one time a very high surplus of about 330 billion, and then it slowly started to come down as that spending, you know, the taxes, we all hate to pay taxes, but one thing you have to understand is that it gets recycled back in the form of, you know, ongoing spending by government. It takes time, though, and it took all the way until May 16th to flip that budget surplus back into deficit. And once it was in deficit, as I've described so many times with my analogy of the swimming pool, that's when the swimming pool hole at the bottom finally got plugged. That's when the water level started to rise, and now we are at an 88, I believe it's an 88 billion deficit for the month of May. There's 3 more statement days in the daily Treasury statement. On Tuesday we'll get today's, and then Wednesday and Thursday. We'll get 3 more statement days. We'll end up near a 600 billion month. That'll be 4 600 billion months in a row, and again, we're back in the normal pattern of monthly deficit spending, and that is true liquidity provision into the market. Everything is driven by these flows. I know that outside of myself, all you're going to hear about is the Fed and central banks and monetary operations, and you know what's going to happen to interest rates, and are they going to do QT? Are they going to do QE? All of that stuff. To me, I don't pay attention to that stuff other than to understand or to realize that that affects people's behavior, because again, it's a psychosis. It's a mental illness. That's the only thing the financial world pays attention to. Central banks. It's really like an incredible thing. If you learn one thing from me, or 2 things you should learn from me. Number 1 is to ignore all that stuff, maybe with the exception of just understanding how it affects people's behavior. And number 2, focus on the fiscal flows, because that's the real money moving in and moving out. I should also say that banking it's not a fiscal flow, but it is a provider of credit. And that is also something that, you know, I go deeply into that in my weekly reports, MMT Trader, where I break down all the banking data on a weekly basis as it comes out in the H.8 Fed release on Friday afternoons. As a matter of fact, I got to go look at it. But if you focus on that stuff, and ideally if you subscribe to my report, because I do a full breakdown and analysis on that every week, you will have the components, or you will be understanding of the main components that drive economic activity. Now, I saw some more stuff today. I've been talking the past couple of days about the revision in the spin. The spin being, everything is terrible. The Fed's got to raise interest rates. We have inflation, and so it's just like the economy is going to get crushed, and it's going to go down. And there was one headline saying, the market doesn't seem to be discounting or factoring in the possibility of a recession. Well, I would say, we had a 20% correction in the stock average, in the averages. I would say it's much more likely, and heavy short positions. We saw put call ratios elevated for so long. We have seen the AAII weekly sentiment survey extremely negative. The bull minus bear spread in the AAII survey has now been negative for 26 weeks, for 6 months. So I would say it's not. I would say if the market is missing anything, or not reflecting anything, it's not reflecting the possibility, I would say even the likelihood, of an economic rebound and a renewed expansion after that first quarter, slowdown. We took a little bit of a hit in the fiscal because of the expiration of the child tax credit payments. And then we had that big liquidity drain, which was tax related, April 18th through May 13th. And now everything is reverting back to the normal flow, and market's been tremendously beaten down. We're coming into the so-called QT, the quantitative tightening, next week, which everybody is, of course, freaking out about that. And I've seen commentary along the lines of, it may be rallying now, but just wait until QT. Just wait until they start the QT. And I told you that reduction in reserve assets at the banks, as a result of the Fed reducing its balance sheet, that reduction in reserve assets, the banks want that. That's a good thing. And that literally improves their financial position from the standpoint of the leverage ratio and compliance to the leverage ratio. It actually makes their capital, their available capital now, more impactful, more effective. They can put it to use for lending. So as I said earlier, the main components or drivers, number one is the fiscal. That's the high-powered money. That's real liquidity provision. But just behind that is credit provision, at least up until a point. And so you got both of those things coming together right now. We got through the April tax drain. And the QT is going to help. I mean, it's going to start out a little slow at first at $65 billion a month, but as it progresses to $95 billion a month, the more the Fed can reduce reserve assets, that frees up space on bank balance sheets for other assets such as loans. We're going to see an increase, or at least sustaining the current trend in credit creation, which is going to be positive for the economy. All right, and if you're worried about high levels of debt, the important thing is the ability to service that debt. So debt service burdens, household debt service burdens, even with the 2 rate hikes that we've had, even with the expansion or the increase in the nominal level of debt, those debt service burdens are still pretty low, definitely low relative to the peak that we saw in 2007 when it got up to something like 13.6% of disposable income. Right now it's at about 9% of disposable income, so it's definitely not at any sort of a worrisome level. So there you have it. I mean, I told you a couple of weeks ago that was the bottom. We're going to see a market advance. Things are, as a matter of fact, I should add too that even and I kind of spoke about this in the fourth quarter of last year when I was discussing the end of the child tax credit payments And I was talking about how the increase in Social Security this year, because of cost of living adjustments, everyone's getting a raise in Social Security, that would offset some of the fiscal drag from the end of the child tax credit payments. And as a matter of fact, we're seeing that. There is a very noticeable, and I've sent this chart out to my subscribers, there is a very noticeable uptrend in daily fiscal flows. I mean, it's not going down. If it was trending down, I'd be a little bit worried, but it's not. It's trending up, which means that the increase in Social Security payments, Medicare, Medicaid, and probably military spending based on, all the spending for the Ukraine war. I mean, that has just put the fiscal trend on a nice upward trajectory. We're not where we were last year when we were, in the full-blown pandemic stimulus provision. But look, I mean, it's trending in the right direction. And so the market's going to go up. I mean, that's your liquidity pump. That's your fiscal pump. That is, what's going to eventually, we're going to see an economic rebound. Actually, if you look at even the other day, yesterday, when we got the second revision to first quarter GDP, it was worse. It was 1.5% negative. But again, you saw very strong personal consumption, very strong business investment. The negative, what pulled it down was a lower level of inventory accumulation, big trade deficit, all right, and lower levels of government spending, okay? But when you look at the biggest component is personal consumption expenditures, and that was big. Oh yeah, on that note, let me mention this, and most of you probably, if you've been following the financial news, the business news today, you probably saw headlines about inflation cooling down in April. Personal consumption expenditure price index was up only 0.2%. That was way less than what it was in March. And again, I'm going to state something that I said before, is that the Fed overreacted. The best policy would have been patience. We're starting to see these supply issues abate, dissipate. The Fed, once again under Powell, caved in to all the people crying and screaming about they got to raise rates, and they got very hawkish, and they did a lot of damage to bank balance sheets with the crash that we saw in government security prices because of their hawkish comments. I mean, day in and day out. And now we see, with the exception of oil and maybe some areas in food, we're starting to see price pressures abate. And this was totally predictable. I said this was going to happen. They're going to go ahead and do another couple of rate hikes, which I think is totally unnecessary, but they're going to do it anyway, and that'll be it. Anyway, that's it for today, folks. Have a nice weekend. Enjoy your Memorial Day weekend if you're going to celebrate it, and hope you get some nice weather, and maybe I'll see you tomorrow. Bye.